Welcome to Investors Guide. Thank you so much for tuning in. As we go into the festive season, we'll help you pick the right investment products and also prioritize your money so that you can be smart about your spending in this festive season. In the next half hour, we'll relook at our top mid-cap funds for this year and tell you what you should be doing with your money if you want aggressive returns. In our product review, we look at the SBI Magnum Global Fund, and we'll also find out if investors should stay away from PPF and why. Let me bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us. Of course, it's the festive season in our run-up to the big Diwali, Dhirendra. I hope you're having a good festive season. I think there's some time and energy that should be spent talking about spending at this time of the year, because we get some liquidity in our bank accounts, and we're all hoping for good Diwali bonuses. And there's so many avenues to spend, and a lot of times there are people who complain about the fact that money just flows through the system, like water during the festive season, because you have to give bonuses, you have gifts to buy, there's travel to be done, and there's a certain need to, sort of prioritize and be a little organized about the way we spend money. My first question to you is, should we be using a portion of our Diwali bonuses to pay off our loans before we spend on anything else?
Yes, Diwali presents a big opportunity to spend, and we see the spending all around us, and we are tempted to do that. But I think it's an important reminder that by all means, celebrate, by all means, spend on the essentials, or be a little liberal with your spending around Diwali. But don't borrow to spend. I've come across, there is a service, there's an online service, Pepperfry, which sends a mail on 1st of every month that, your salary is credited, now it's opportunity to splurge. And this Pepperfry is a very small fry. You have the big $1 billion purchase day, and, by Amazon and Flipkart and the Snapdeal. I think resist your temptation. And, one ground rule which most people should follow is that don't invest your future income. Don't borrow any money to spend right now. Because, these impulse purchases, impulse spending will just be a big, it's a very anti-saving, it drives a very anti-saving culture, and you just will not, because the starting point of investment is that you should be able to save a little bit, and when you mortgage your future income by spending it today, that occasion does not arise.
Also, Dhirendra, my personal advice would be to use some of the money to pay off some loans, whether that's especially starting from credit card outstanding or personal loans or auto loans. It always makes sense to bring down debt in our portfolios. Would you recommend that Diwali bonuses be used to pay off loans as well?
Oh, definitely. If you are actually getting a meaningful Diwali bonus, then by all means, if you can repay a part of your loan, or if not, at least invest, if it has come your way and it's a bonanza, and if you are able to save a good part of it, think in terms of, money, invested today will be substantially more. Of course, repaying a loan should be the starting point before you start investing. But make sure that, if you are able to repay, definitely invest a part of your bonus.
All right, so here's some advice for the festive season, or going into the festive season for you. Why don't you sit down with your family or with your spouse and actually write down the things you want to spend on, whether it's furniture or it's jewelry or it's travel or it's anything else. Once you prioritize and write it down, then it sort of limits your ability or limits your need to go out and make impulse spends. And you know exactly the kind of money you're going to be spending this festive season. Use some of the cash that you have to pay off your loans. It makes you more efficient. Start from, the credit cards, which is the most expensive, the personal loans, the auto loans, education loans, and home loans. That's the order in which you should be paying off your loans. And like Dhirendra said, and this is so important, don't mortgage any future income unless it's for an appreciating asset. And that is real estate. So don't, of course, take a loan or opt for EMIs on your credit card or take a personal loan in order to just buy something that will depreciate in value. These are our tips here for the festive season. Let's move on now to talking about the mid-cap funds that Dhirendra recommended as the top mid-cap funds for 2016. Well, these are the top mid-cap funds for 2016. BNP Paribas Mid-Cap, Mirae Asset Emerging Bluechip, and HDFC Mid-Cap Opportunities. When you look at all of these three funds now, and I really hope that there are young people who are watching the show right now who are going to use some of their Diwali money to invest in mutual funds. And if they're investing in mutual funds, are these the funds to go with if you're young and you don't mind taking on the risk and you have a good 20, 30 years ahead of you?
Yeah, mid-caps, if you have that kind of time frame, then it's not a bad idea. But generally speaking, if you have, a lot of investors have poured money into mid-cap funds. They have benefited. Many mid-cap funds have, beaten the Sensex by a wide margin simply by their design or the market preference. But I'm getting quite, scared about the mid-caps for the medium term. If you have a short-term time frame, then it could be disappointing. The other problem with somebody getting started with a mid-cap is that if you start your investing now and you are faced with a disappointment for the next, 1.5 years, because the market is shifting towards, we are finding that, some of the mainstream large cap stocks are gaining favor, or a lot of problems which was holding them back, now they are getting cleared, or they are getting solved, or some of the factors which will drive their earnings is getting back in place. So we will see a shift, and we have seen this big surge in the mid caps, and which has driven the valuation. They look very expensive, and markets are cyclical. What is cheap today because it is out of favor will get in favor, and what is in favor, which many mid caps were, will go out of favor. So that can get a little scary for investors getting started. But if you have a 10-year time frame, the mid cap that we recommended, they remain very promising. They have been outstanding performer, except for BSE, the BNP Paribas mid cap, which has struggled a little bit. It has turned a little conservative, but it has all the variables of a good fund based on which we recommended it, and that is very nicely in place. Maybe that this is a fund which will also be able to navigate a downturn which I was referring to, or not so great performance from mid caps in next 1.5 years. And that is something which I would like our investors to, be sensitive about. That mid caps, the great days may not continue as we have seen in the recent past.
So if the great days are not going to continue, Devendra, what's your advice for people who are holding mid cap funds right now? Would you recommend, including the three that we're talking about, would you recommend to continue to hold on to them, or is it time to take some money out and move it into something a little more secure?
Depends, because it's very tough to time this, and I don't know whether it happens in the next 3 months, whether it happens in the next 1.5 years, or whether it may not happen. But I'm generally of the view that something becomes very expensive for a certain reason. Things change, and the market complexion changes for a variety of reasons. And so those variables, if they don't fall in place, it may not happen. If you are in an accumulation phase, if you are investing for next 10 years, ignore my view. It doesn't matter. Maybe it is good that the market, the mid caps will correct, and you'll be able to buy it cheaper, and great funds will do much better than the general mid cap funds even. For most other investors who will get unnerved by a big decline in the value, in the price of mid cap funds, they should not have been there in the first place. They should be with the multi caps, where the fund manager will take a call, will change his view or change his preferences, tilt his portfolio appropriately, and one should get a full market exposure with such vehicles which will not really scare you. If you are a very conservative investor, then you should not be with any of these funds, even the multi-cap funds. Get started with a stable growth portfolio. Maybe those are the kind of funds which will not scare you, which will not disappoint you, or you will be able to navigate a declining phase of the market reasonably well, simply because there will be a 30-35% fixed income cushion. Even the equity portfolio will be a little conservative. So I visualize that if we have a market which is changing its preference, then those are for naive investors, for first-time investors who don't have great background in terms of being in the market for a long time. Those are the vehicles which one should be with.
All right, so that's the advice you're getting. Remember, if you have a mutual fund in your portfolio, whether that's mid-cap or otherwise, and you want some advice about it, feel free to get in touch with us. Our email ID is at the bottom of your screen. Let's move on now to our financial plan. The profile we're looking at this week is a 35-year-old with 2 dependents He's a first-time mutual fund investor. His goal is his children's education and his own retirement. Rishi has written in from Hyderabad, Virendra. His goal is 3 crore rupees for his children, 2 crore rupees for his own retirement. And his financial details, I love the way he's put them together. They're very organized. He has a salary of 1.1 lakh rupees plus business income that is coming in as well. Term insurance looked after. He has health insurance. He has PF deductions going in. He also has a home loan from SBI that he's paying off right now. So he seems fairly together. He wants to now invest in mutual funds and he wants to know how to go about it. Now, 35 is a great time to start. It's not too late. He still has enough time to focus on both of his goals. I don't see an emergency fund here other than the PF that he's mentioned. Would you like him to start with the emergency fund and then move to investing in equity mutual funds?
Yes, that definitely is a starting point. Term insurance if you have a family or dependents, and the emergency fund. And after that, he should definitely try and organize, tweak his portfolio a little bit. Some of the things that he has done, he should reconsider that. One is the PF, about which the whole debate is going on, that should one not. And the other is the other endowment policy and other things that he would have picked up in the past. He should consider getting rid of those. That is just blocking his regular savings and will not provide him the optimal return. And he doesn't require any of that, because he has taken if he has taken adequate term cover, then he should do without, one should not get into any of the endowment plans or the ULIPs. He should consolidate all his savings and take one of our funds, either the aggressive growth portfolio or the growth portfolio, and invest regularly. I'm assuming that he's unlikely to he's unlikely to require a tax saving fund or tax saving investment, because his entitlement will be consumed by his employees' provident fund contribution.
All right, so on your screen right now is our aggressive portfolio and our growth portfolio. Feel free to write to us if you have any more questions, but you seem to be on track. You're keeping it simple, which is the most important thing. So what you need to do is put together an emergency fund that will cover anything you need in terms of an emergency, so you don't have to break your mutual funds for that money. So once you've done that with your life insurance and your health insurance, you're good to go. So you can pick one of our portfolios and start investing. The interesting, we look at, of course, your endowment policy and think about whether or not you want to continue with that investment. Now, here's the interesting question of the week. Virendra, Gurudat Mundarkar has written in. He has says that we keep advising people to avoid the PPF, which we do, and it's a stand that we stand by. He wants to know if we consider PPF only for our parents and grandparents, and why are we telling young people not to invest in PPF, because they will be parents and grandparents soon enough. And he says, if someone had 10,000 rupees to invest every month, shouldn't they have all different allocations in their portfolios and not just mutual funds? That's his question. Now, let me first qualify the statement of parents and grandparents. The idea is that traditionally, our grandparents and our parents use the PPF because there's very little access to other forms of investment. Today, in this day and age, we have other options. We have various kinds of mutual funds, we have various kinds of insurance policies, and of course we have the NPS, which are all choices that offer us alternatives to the PPF. So that's what we meant by you don't have to go with the investments that your grandparents went with, because they didn't have the choices that you have today. To answer his second question, Virendra, which is, shouldn't a person with 10,000 rupees to invest in every month invest in everything? What is your answer to that? Should he still be investing in the PPF?
The fundamental way of looking at any investment is whether it is an equity or a fixed income, or it is a physical asset. Equity, fixed income, and that is something which you have to really define, that long term you should consider equity. And if you are looking for, if you are seeking income from your investment, then you should consider fixed income or even physical assets in terms of real estate, which will produce a rental income for you. Of course, it has its own dynamics in terms of the ticket size and manageability. But that part, equity and fixed income, if they are the basic underlying, investment avenues, then there are different ways of accessing it. Fixed income fund or PPF or a bank deposit, these are different ways of, making a fixed or buying a bond, are different ways of buying, making a fixed investment, which will derive from which you can derive fixed income. Fixed income is not a great way for your long-term regular savings because equity produces best possible return over a long period of time. Equity is volatile, and that actually makes us think that it is risky, and that is to your advantage, but because when you are investing regularly over the next 15 years, that is what exactly you do with your PPF, then you are able to average your investment and you are able to optimize your return, and you are also able to eliminate the possibility of taking a big hit with your equity investment. PPF kind of investment which you make, a recurring investment to be made over the next 15 years for accumulation. Our parents and grandparents did simply because they didn't have any other option. And also the safety and security which is perceived or it is not a solution to optimizing or maximizing return. So it's a huge opportunity loss. I would say that if grandparents, if they have accumulated their savings in PPF and if they are deriving regular income out of it, it is fine. They didn't have the choice, and now for their income, it may be a reasonable choice or it may be a reasonable investment. But for somebody accumulating over the next 15, 20, 25 years, it is a very unwise thing to do. It will be leaving a lot of money on the table. You will not be able to beat inflation. More so, the dynamics have changed. Investors will saving now. Their working life might get reduced. You will be in a volatile career, and optimizing your saving, return on your investment will be crucial to being well off over such a long time period, which PPF will not be able to deliver.
All right, so I hope that gives you your answer. And it's very simple, really. You have to pick your investment based on who you are as an investor, what your personality is like as an investor, and of course how far away your goal is in terms of time. So the further away your goal, the more important it is for you to invest in equity that will beat inflation and give you stronger returns as opposed to investing in the PPF that gives you set returns. And remember, a lot of investors don't realize that the PPF doesn't have a fixed return. It is a return that is decided every year by the finance ministry. So it's very likely in a lowering interest rate regime that the interest rate given to you by your PPF will also come down over a period of time. So if you think that 8.45% tax-free is what you're going to get for the next 20 years, that might not be the case. That's something that you should take into consideration as well. If you still have points that you want to rebut us with on this particular stand, feel free to get in touch. Email ID is on your screen, so is our Twitter handle. You can get in touch and tell us what you think about the PPF, and we'll be glad to answer any questions. We're going to take a quick break, but remember what we talked about in this segment, why you get some Diwali money, and you are going to splurge. It's important to be mindful of the spend that you're making. So write it down, have a conversation with your spouse, make sure that you understand the kind of money that you're using. Also, don't borrow and spend on Diwali. Try and work within the means of the cash that you have, and also try and pay off some of your loans. It's time for us to look at our product review. This week we're reviewing the SBI Magnum Global Fund. Avan will give you the latest on the numbers. Avan.
Thanks, Faye. This week we take a look at one of the mid-cap funds, the SBI Magnum Global Fund. With 4 stars on value research, the fund has performed well over the long term. But how does its performance look in the short term? The red line is the fund and the blue line is the benchmark. You see that the fund has outperformed its benchmark both in the bull and the bear phases of the market. In fact, the fund has had stellar returns in the year 2014 with a return of 67%. Additionally, the fund's performance has been better than its benchmark and category in the 3, 5, and 10-year periods. In the last 1 year alone, the fund has underperformed its benchmark and category with a return of 8%. In fact, its peers have performed better than this fund in the short term. So should you continue investing in this fund? Let's find out. With that, it's back to you.
All right, the SBI Magnum Global Fund still remains 4 stars. Returns have been impressive. It's stayed an impressive fund. Is it still a fund that you would recommend to investors?
Yes, absolutely. This is an outstanding fund, and it may not, do just as well as it has done in the last 3-4 years, simply because, the kind of stocks that it invests in or the way it is supposed to invest, that whole segment may not work. But I think among the mid caps, it has a very well articulated, strategy or design or the way it is supposed to function. It's not supposed to invest in the top 100 companies. It is supposed to invest in, mid-sized companies below top 100 capitalized universe and up to 500, and companies with high return on capital and high growth of upwards of 15%. So, 15 to 20% return on capital, and so that actually defines your universe. So that itself, gives a very different kind of quality bias, a well-defined universe, and companies with some competitive advantage. So these three things, growth, return, and a set of companies with competitive advantage. I think that makes it a very compelling high growth company fund. And if the fund sticks to what it is what it has articulated it will be doing and not doing, then I think investors should invest confidently in this fund to expect extraordinary return from such a fund.
Invest confidently and expect extraordinary returns. Dhirendra, what is your star rating for this fund? Where would you place it?
If the fund actually does only what what I just said it's supposed to do or it intends to do, then it definitely is a 5-star fund, much above the the 4-star rating which it gets on a risk-adjusted scale.
5 stars there for the SBI Magnum Global Fund on Investors Guide. Dhirendra, before we move into the next question, I have a very quick question for you. This is an illustration of why we always say investors should avoid thematic funds. We've seen some sort of weakness in technology or the IT sector, and we've seen that weakness reflect in most tech funds or IT sector funds. What's your advice to anybody holding an IT fund right now? While the AUMs tend to be fairly low, which means there are very few investors who are still holding these funds, would you recommend they continue to hold them?
Indian technology companies have become mainstream over the past couple of years. They have become large businesses, and I think in the whole technology investing universe for the technology services company universe in India is very unusual. It is made up of 5 companies, and one is exactly the half of the previous one. TCS, Infosys, which is half the size, and Wipro, which is half the size of Infosys. So made up of 4 or 5 companies, growing at somewhat similar pace. Different combination, but I don't see a very different, and there's all kind of anxiety, and these are, my understanding is that these are all short-term anxiety, and all these companies have a fairly, I would not say very aggressive, but if you look at Infosys, it claims to be a $20 billion company in a defined time frame, or TCS is targeting a certain thing. So that actually, and all these businesses have gained great maturity. A portfolio made of 5 things, don't dabble with a technology sector fund, don't dabble with a technology fund. Entrust your money to a fund manager who will decide which business to buy, and when not to have any of these businesses. I don't think you are doing anything meaningful by being in a technology fund. Ignore that altogether.
Ignore tech funds altogether. Does not make sense. It doesn't fall within the point of a mutual fund to actually have a tech fund. That is the biggest advice that you can take away. So take a look at your portfolio. If you have pharma funds, tech funds, infrastructure funds, it makes sense, really, honestly, to get rid of them. Right now, we've run out of time, but we'll be happy to help you with anything that you need. Dhirendra, thank you so much for answering our questions this week on Investors Guide. It's always a pleasure to chat with you. Going into the festive season, we are here to help. If you need anything, email ID is at the bottom of your screen. Thank you for watching.